Hello everyone, welcome to our financial accounting session. Today we'll discuss the next problem, problem number 13. So here we are going to discuss the next method. So that is journal entry preparation. Now the question is Mr. Ashok purchased a machine on hire purchase system from Bharat Motors on 1/4/2006. The cash price of the machine was to be 74,500 and the payment was to be made as follows. On signing of the agreement, rupees 20,000 and the balance in three installments of rupees 20,000 each at the end of each year. And 5% interest is charged by the vendor. Mr. Ashok has decided to write off 10% depreciation annually on the diminishing balance method. Now we need to calculate the journal entries in the books of Mr. Ashok under asset accrual method. So here we are having the cash price of the machine 74,500 and the year start with 1st April 2006. Right? And the down payment of the machine will be 20,000 and the installment amount also 20,000 for each month and total installment will be 3 and interest rate is 5%. Depreciation is 10% in diminishing balance method. Now the rate of depreciations we are going to use in this problem. Right? Okay. Now we'll discuss the problem with asset accrual method. So whenever we are going to solve the problem in asset accrual methods, before going for the journal entry or ledger, first we need to create three mandatory stages. Right? One is interest in each installment, and second we need to create or calculate the depreciation value, and third cash price of each installments. Now we'll discuss one by one. First, interest calculation in each installments. Right? Now the cash price of the machine is 74,500 and the down payment is 20,000. So 74,500 minus down payment, you will get the 54,500 balance due. That will be the outstanding balance after deducting the down payments. So the interest calculations, installment amount, everything will be calculated for this balance amount only for 54,500. Now, in this question, we are having 5% of interest rate for the year 2006. 54,500 into 5 divided by 100, you will get 2,725. So that is the first year interest. We need to add this interest value to the outstanding balance. So if you add, you will get 57,225, and then we can minus the first installment amount, that is 20,000. So 20,000 each for three installments. So first installment 20,000. So balance you will get 37,225. And again we can add second year interest of 5% for 37,225. Right? So 37,225 into 5 divided by 100, you will get 1,861. So if you add this value, the balance amount will be 39,086, and then you can minus the installment paid for second year 20,000. So the balance you are getting 19,086. Now for third year, we need to add 5% of interest. Right? If you add 5% of interest, the amount will exceed above 20,000. Right? Because here the customers, Mr. Ashok, is paying 20,000 for each installment for the three installments. So first installment also he is paying 20, second installment also 20,000, and third installment also 20,000 he is paying. So instead of calculating for 5%, because customer are going to pay only 20,000, so for third year you need to calculate the balancing figure will be the interest value. So 20,000 you can write, and out of 20,000, then you can minus the balance due, that is outstanding balance of 19,086. You will get 914 as an interest. So this 914 will be the balancing figure of interest. Right? Now you are having the 20,000 and installment paid 20,000. So outstanding balance will be nil. Right? So this is the stage one, calculation of interest for each installments. Now we can move on to the second stage, calculation of depreciation. So here the machine price is 74,500 and depreciation is 10 percentage in diminishing balance method. So first year depreciation 7,450 and balance 67,050. Second year depreciation is also 10 percentage. So here we are using the diminishing balance method. So the depreciation will be calculated only for the outstanding balance. So when you are in the second year, the outstanding balance will be 67,050 and you need to calculate depreciation only for 67,050 for 10 percentage. You will get 6,705. So the total value will be 60,345. And for third year depreciations, you will calculate for 60,345 is 10 percentage of 6,035. Now the exact value of the assets is 54,310. Now we can move on to the third stage, cash price of each installments. So to calculate cash price, you can use this formula, installment minus interest. So every installments, Mr. Ashok paying 20,000 rupees as an installment value. Now already in the problem we have calculated interest, right? In step 1 we calculated interest for each month. Now you can easily calculate for first installment. The installment value is 20,000 and the interest value is 2,725. So balance 17,275 is the cash price of first installment. And for second installment, 20,000 minus 1,861 equal to, you will get 18,139 as a second installment cash price. Third installment also 20,000 minus the balancing figure of the interest is 914 equal to, you will get 19,086 as a cash price. Now we done all three stages, step 1, step 2, step 3. Now we can able to calculate or pass the journal entries with the help of all these three stages. Now we can move on to the journal entries. So when you are creating a journal entries, so here you need to understand only the 5 major concepts of the journal entry. So first journal entry we are going to create for making the down payments, right? And second journal entry we will create for the outstanding amount of the installments, and third journal entry we are going to create for making the installment value, and fourth one is for depreciation, fifth one is for profit and loss accounts. Right? So first year only the down payment journal entry will appear, because down payment we are going to pay at the initial stage only one time, and all other 4 journal entries will repeat for upcoming years or upcoming installments. Whatever the installments you are having, it may be 3 installments or 5 installments. The 4 journal entries will repeat for second installment, third installment, fourth installments until your installments are getting over. Right. Now we will do for the first year, right? So the accounting year is starting with 1/4/2006. So Mr. Ashok is purchasing the machine on 1/4/2006, right? Now he's paying the down payment of 20,000 on 1/4/2006. So machinery account debtor to bank account 20,000, and second entry for being the first installment due. So here the installment value will be 20,000. He need to make the installment value to Bharat Motors account, and the 20,000 including machinery value plus interest amount. So machinery value is nothing but the cash price of the value for the first installments, right? So machinery account 17,275 and interest account 2,725. So this already we have calculated in the stage 2, right? Stage 2 and stage 3. And now third journal entry for making the payments. Now you are going to make the payment of in first installment. So 20,000 you are paying to Bharat Motors account. So Bharat Motors account data to bank account. And fourth journal entry is for depreciation. So depreciation already we have calculated for 10% of 74,500 with 7,450. So depreciation account data to machinery account. And the last one is for profit and loss account. So depreciation and interest will be debited in the profit and loss accounts. So profit and loss account debit 10,175. So this 10,175 how we arrived? So interest value plus the depreciation, right? So here we are having the interest amount 2,725. Already we are having the second journal entry, and the depreciation account 7,450 for the first installments. So both the values you can able to view here only. So these two value you need to add, you will get 10,175 as a profit and loss account. So the profit and loss account, it's a total of interest amount and the depreciation amount. Now we can move on to the second year installments. So second year installments, here the down payment journal entry will not repeat. All other four journal entries will repeat, right? And here also the same machinery account data to interest account. So machinery account, interest account data, and to Bharat Motors accounts. So the installment value will be 20,000, and this 20,000 includes interest of 1,861 and 18,139 of cash price. And now the second entry is for making the payment of 20,000. So Bharat Motors account data to bank accounts. Third entry for passenger depreciation. So here you are going to charge the depreciation amount. So depreciation for the second year will be 6,705, and to machinery account 6,705. Now you are going to transfer the interest and depreciation to profit and loss account. So interest account 1,861, depreciation account 6,705, and profit and loss account you are going to add these two value. You will get 8,566. Now we can move on to the last installment, that is third year. So third year for 2009. So he is purchasing the machine for 1st April 2006. So the entry will start with 2007 closing date. So for the first year, and for second year it's a 2008, and now we are in third year, it will become 31st March 2009. Right. Now for the first journal entry, it's being third installment due. So the due amount is 20,000. This 20,000 includes interest of 914 and cash price of 19,086. And second entry for making the installment amount to Bharat Motors account. So Bharat Motors account debit 20,000 to bank account credit 20,000. And third one is for depreciation account 6,035 for the third year depreciation, and to machinery account 6,035. And last one is being transfer of interest and depreciation to profit and loss account. So here interest account credit 940, depreciation account credit 6,035, profit and loss account, both the values together will be 6,949. Okay. So I hope you understand these concepts. So whenever you are getting the question to pass journal entry, you need to create the mandatory stages of the first three. You need to calculate the interest value for each installments and depreciation value, and then cash price of the machine for each installments. Okay. Thank you. We will see you with the next problem.